We're going to take you through the futures options hedge strategy. Our spread here, I've marked it up on the chart. The blue area is where we want the market to stay. We want it to stay within those boundaries. If it starts to get within the extremities of those boundaries, we're starting to red cross there. We start to get short. And what we're doing is we're working a trailing stop. So it's really a momentum breakout system. Very simple, but it just works brilliantly. So we use one large S&P for every full spread that we trade, and we have that spread, we have that large S&P contract working constantly in the market to protect and hedge against the trading. You can see it's short at the moment, then it gets triggered into a long, and then it gets a bit of a pullback, then it keeps going long. So you're actually taking premium as your stop starts to come down and trail the stop. So I'll just tighten that up a little bit here and go to the area that I need to. So you can see here that we traded long and short positions for the course of this spread, just protecting our spread in case of that big breakout move. And you see here on the 29th of May, we get a huge breakout in the market and we start to challenge that 940 area. Now remember, our traders Bill and John, they would be at this point feeling pretty uncomfortable with no protection apart from, well, Bill actually had the outer calls, but John had no protection, so he would be feeling a lot of pressure, obviously exposing himself to a margin call as well, and potentially unlimited risk. But let's have a look at how we're faring. So we're long here at 893. We don't really care if basically we're long on this futures contract, remembering that the futures contracts are designed to hedge against the options, because what they do, and we'll talk about this a bit more when we go to span margining, the futures offset the options because of their delta. So with span margining, they basically, for every futures contract you trade has a specific delta, it'll be 1, and if the options will have a delta of say 0.12, so you're actually positive on your delta when you're trading futures against options. So if we're long the futures here, and we're short the calls, or we're sold the calls, then we're actually net positive on our delta. So we're protecting ourselves for we're making money on the way up, and are losing money through time value. Obviously, they're potentially gaining some value because the market's pushing closer to their strike price, but that's being offset by the money we're making on our futures premium. So that's really how the strategy and system works. We hold our futures position until we get a corresponding short, and that does happen. We get up here and we get a short position here just below the 930 level, and we go short again, take a little bit of premium there, and then we get triggered into another long, so we're long again. So we're constantly taking premium on this trade, short and long, and we push well through the strike price there, through the actual spreadsheet where we track our futures trades. But basically, I'll take you through all the trades that we're taking during that period, and you can see that we're finished basically at our strike, well above our strike price. So so we actually start our position here on the 20th of April, and we bring in our $3,000 worth of options premium. It's around about 2970, and here is basically our trades as they set up daily. So you can see that we're taking trades every time a trade sets up on our hedge line. We'll take it, and we can see here that we get winners, losers. There's some periods of choppiness, and then you'll get breakout periods. But let's go forward until the date of the expiry, which was the 23rd of July. So our last trade was the 21st up until the 23rd, and we ended up with a total premium of 64.5 points. So from just using our futures hedge, we actually pulled in 64.5 points on that. The market rallied and pushed towards our sold calls. If we had not have had that hedge, then we would have just been basically relying on our premium to cover our trade. So let's have a look and see how we fared. So they were the trades that were logged from April through to the 23rd of July, bringing a premium of 64.5 points, and that is on our $100,000 portfolio, so we'll just push that over. Before we do that, we'll just have a look. So this is where we end up. That's where we end up on the on expiry. So well above our point where we needed to be, and obviously our strike price was 9.40, so we're well and truly above where we had our strike point. So we were wrong in our options, so we got our option spread wrong, and let's see how we did. It's time to have a look at how we went. So remembering that our initial premium was $3,000, our losing spread trade was $20,000, and our futures hedge netted 64.5 points. Now it's basically designed just to do that, just to protect our options. So we had a losing option spread of $20,000, and our futures hedge brought in a premium. Alright traders, so let's have a look at how the key equity hedge performed there. Had an initial premium of $3,000. Our losing spread was 20 grand based on the market finishing above our 940 calls, hitting the 960 level. So that was 20 points times 250 times 4. Our futures hedge netted 64.5 points. Now, obviously, our hedge strategy is really not designed to be anything but just a hedging strategy. That's it. It's just to protect our options in case the market accelerates up to where our strike points are. And we see here 64.5 points premium, which is around about $16,125. So if we combine that with our initial premium of $3,000, that leaves us with $19,125 worth of profit. We take that away from our loss on our options, and it leaves us with a net loss of $875 for that trade. So as far as our protection goes, we've more than covered the risk on that trade, and there were points during that entire strategy where you could have actually exited the trade for a full profit and not been exposed to the $20,000 worth of risk there. But if you just decided that you just were going to let the trade play out, you don't want to do any active trade management, then your maximum risk there was $875. So that's a super result based on the fact that our other two traders are down significantly on their portfolio. One need to remember that that's less than 1% of our account, whereas our other two traders have wiped out 14 and 17% respectively. Let's have a look at our performance so far. This is to July 2009. We're sitting at around about, for our mini account, 49%, our gold account 60%, and our platinum is 63%. So the system is performing beautifully. The volatility and periods of fairly flat action, and this is fairly consistent with what we've seen in the past as well. So it's an exciting strategy. So this is a very exciting strategy, good peace of mind, and it just enables you to be able to trade and set your spreads, have your account, your futures hedge running, while you just relax, sit back and enjoy the confidence that that if you have a big move on the S&P or whatever market you're trading, you've got that ability to protect your underlying asset or your capital. So that'll wrap it up from me. Thank you for your time. Looking forward to catching you in our next video. So if you have any questions, feel free to send us an email. Other than that, we'll see you in the next module. Cheers.